Welcome to the Coliving Circle Podcast. I am Paul Burke, the host and founder of Coliving Circle, and I'm calling this season two because it's probably been about 4 to 5 months since I've recorded the last episode, and I'm really excited for the guest we have today. I'm interviewing Matthew Ryan, who's the president of Re-viv, a private equity investment company that acquires and develops housing in up-and-coming neighborhoods. One of their focuses has been on co-living, and Matt and his team have done a great job putting out content on sort of their journey and also different things about co-living that we're going to talk about. Matt, great to have you on.
Yeah, it's my pleasure. Thanks for having me.
So this is kind of the first question I always start out with, but we've had people come from really all walks of life, from fashion to hospitality, like on big cruise ships, to discovering co-living. Talk about your journey to finding co-living, and then what was the thing that hooked you to it, to where you were like, okay, I'm actually going to explore this as a career path.
Yeah, yeah, absolutely. So I got introduced to co-living actually from a colleague of mine. And it was basically a company by the name of Open Door, not to be confused with Open Door has an iBuyer platform, but actually Open Door, who's a co-living property management company and small scale development company here in Oakland. So I met Ben Provin and Jay probably 4 or 5 years ago. And I can't remember the exact connection, but I ended up having tea in their tea room in one of their co-living developments, which is so totally California, and also
Yeah.
within the co-living community.
And it's tea, not coffee.
It's tea. Well, they had coffee, but we settled on tea because we're both tea drinkers. And I'm sitting here in basically this up and coming neighborhood. The ground floor retail, commercial space had been converted into kind of a co-working space and this back tea room. Ben, he's always been huge on this sense of community, and what co-living is. And that's kind of centered around that element, right? Not just a real estate investment project. And I just remember, chatting him up, and we both came from energy efficiency and green building and clean tech. And so we had a lot of commonalities, and, I loved what they were doing. And that was really my first introduction to the co-living, and kind of, that idea of it. And it wasn't till really after we secured our first project in Sacramento, I had formed another relationship with a very prominent design and build company here in Oakland as well, who's mutual colleagues with Ben. And so Design Drop Build, the owner Tyler Kobick actually approached me and said, Matt, let's do some of these co-living projects together. Ben's doing very well. There seems to be a lot of opportunity. We had looked at the Oakland Berkeley market before for just traditional value add opportunities. It was very difficult to get deals to cash flow. Being in a rent controlled market with little to no cash flow didn't really interest us from an investment perspective. And we were trying to find a way to pair the opportunity zone tax, credit, so to speak, with their traditional kind of value add approach. It's very much, Ozone's is very much centered around development. And so it was kind of pairing this, success of, small scale co-living that Ben had, very keen interest that Tyler had in regards to growing this model and, growing his construction architectural business partially around that. And just kind of the Ozone, which really kind of drove us in. And I was looking for an opportunity to get into the Ozone market and how we could do these small scale developments. And when I really started looking through the nuts and bolts of, which we'll get into, obviously, I'm sure very quickly, around these smaller co-living projects, it just made a lot of sense. And it made a lot of sense, not just from an investor perspective, but really, how we, from my point of view, how we revitalize communities in a more equitable way, which again, we can touch on. But that's kind of the genesis behind it. And, aside from just having a really two great colleagues, both an operator who's successful, very intelligent, kind of cutting edge architect and general contractor, along with this, kind of once in a lifetime opportunity with Ozones. It was a perfect mix. And so we just kind of took the ball and ran with it, and we launched our Ozone Fund in the spring of 2019. So.
And so you mentioned Ozone, which is stands for Opportunity Zone, right?
Yeah, sorry.
No, it's all good. So
Yeah.
for people who aren't as familiar with sort of the nuts and bolts of real estate and building, talk a little bit about opportunity zones and what it means and how that fit into sort of your thesis.
Yeah. So I'll give people not just the boring tax stuff, but there's actually a really cool story behind it that a lot of people don't know. So Sean Parker, who is the founder of Napster, he's
And
like
famously portrayed by Justin Timberlake in The Social
exactly
Network.
yes for those who are movie buffs as well. He actually helped found this organization called the Economic Innovation Group, and he's become a really big like policy. I don't want to say nerd. I mean, he's really like looked at policy from a public partnership from my perspective. And when he set up the Economic Innovation Group, what they did is they mapped census tracts all across the United States, and they begin to rank them based on certain factors, certain metrics. And one of those kind of key metrics was the I shouldn't say one of the key metrics, but one of the key things they looked at was what is the kind of upward mobility, right? What's area median income, vacancy, and all these other factors. And that ranking system actually became what was the opportunity zone, census tracts, right? And so, and their intent was, hey, we've got an unprecedented amount of capital that's trying to find a place to invest, right? And maybe if we can create a tax incentive to get these people to want to invest in these areas, right? These downtrodden areas, these areas that typically people may want to avoid, or early adopters are slowly starting to already make their way into those markets, right? But true to the market adoption cycle, there's a lot of people sitting on the sideline waiting to see if it's proven, right? And when they established the ozone credit, I mean, to me, it was one of the most prolific private partnerships or private public partnerships, excuse me, in at least the last few decades. And it was Tim Scott of South Carolina, my home state, and Cory Booker, who actually came together to help get the legislation pushed through. And what it basically did was, if you buy a property in the census tract, in an ozone census tract, okay. Well, first and foremost, let's go back. If you sell a stock, if you sell a business, there's various other types of gains. Those are the two basics, right? You have 180 days from that time frame, from that date of sale, or if you're in a partnership, the end of your fiscal tax year, to reinvest into an opportunity zone. That can be a piece of real estate, that can be a business, okay? We'll stick to real estate, obviously, for the purpose of this discussion. If you go and buy $1 million property, you assign, say, $700,000 to the land, you have 31 months to improve that property by $700,000, right? And if you do so, and that you maintain your qualification, okay, as an ozone, and you're following the guidelines, your original capital gain that you invested into that project, that $1 million project, you defer that to 2026, and you reduce it by 10%. You'll pay 90% of what you would have already owed that tax year in 2026, okay? Let's say that $1 million property, if you keep it in there for 10 years, which is the time frame for an opportunity zone asset. If you keep it in there for 10 years, and let's just say it's worth $3 million now. When you go to sell it, you pay zero capital gains on that $2 million. So wow. you get your $1 million back, plus your $2 million back tax-free, okay? So it was really, in summary, it was kind of based around two things. Not only do we want to get capital, attract capital into these areas, right? But we want to do so that in a way that doesn't make it overly competitive for existing housing stock. We don't want to fuel gentrification, right? We want to incentivize development, which some would argue, I stand on the side that, from my perspective, developing a piece of raw dirt, right? Or say, taking a 3-unit complex and turning it into a 30-unit complex has very little impact, if zero impact on gentrification, right? You're building more housing supply, that's less competition, better. And in addition to that, incentivizing these people to look at the long-term trajectory, to be in these communities for a 10-year timeframe, that's a decent amount of time, right? Mm-hmm. So you really there's no like quick and dirty, profits here. This is very much like, you have to be buying into it. And that's essentially the opportunity zone kind of in a nutshell, from the story, in addition to the kind of the tax credit itself. And so it is a very powerful tool, and it's a very powerful tool, especially for those people who, 1031 exchanges are classically difficult to execute in the real estate space. And so Opportunity Zone gives someone a buffer. It gives them a backstop on top of that, in addition to some other interesting tax deferral methods that were also in play with people. So
Got it. So I mean that's super interesting, and I think, like you said, if it's for a period of 10 years, this is not a get rich quick scheme. Um,
no, no, it's
it,
not. And development's not a get rich scheme.
yeah,
It's challenging, especially in these areas too. But yeah, it's definitely. Sorry, I interrupted you, but
no, you're good. So okay, let's sort of, that's a good kind of leading point into sort of what you've been working on the last couple of years, and a post that you talked about called the loss case for mid-market co-living done at scale.
yeah.
So with opportunity zones in mind, talk about sort of what sort of that journey has been like for you,
Mhm.
and I'll just let you take it from there.
Yeah, yeah. As you know, this is it's a thick topic, right? And it's thick in the nomenclature of real estate. So, um, I'll go just one step further back very quickly, again, because I like the story behind, the why behind why we do things. Um, the Revive was founded really kind of based on my experience with a community member. So Miss Pam was the cook at my kids' preschool. She also babysat for us. Um, and I had bought a duplex in an up and coming neighborhood when I was still running my construction company back east. And Miss Pam, she would walk to preschool every day. She'd take the bus to work and to work the night shift to provide for her grandchildren. And one night, my wife and I, were talking about this amazing human being, and just kind of like what an inspiration she was. Um, and we lived 3 doors down from her, and from her rental property, and she was paying obviously far less than what a lot of people in the neighborhood were starting to pay. And again, an up and coming neighborhood, very well located. And the question came up, like what happens to the Miss Pams? Like, how do we, in a larger context, what we were asking ourselves, like, how do we provide affordable housing for everyone? Like those seeking an affordable but well located place, but also those people who are already occupying these neighborhoods for their cheap rent, for their cheap housing. In other words, how do we revitalize neighborhoods in a more equitable way, right? So, you heard the story about co-living and the why behind that, pairing opportunity zones. We were seeing, again, a lot of capital that was wanting to dive into East Bay, Oakland, Berkeley multifamily that had zero cash yield. To me, from my perspective, was incredibly risky to be buying at that level. But people who had seen their properties appreciate so much. And so when we're thinking about this from an investment perspective, we're like, man, if we can take a 2 to 3, 4 bedroom house, right, or duplex or triplex or quadplex that's vacant, or has some vacancy, 75% of vacancy to it. California had just passed the ADU law, which allowed you to add 1,200 square feet. A lot of these need structural retrofitting. So we were kind of looking at this Lego way of, can we convert these houses into like 10 to 16 bedroom co-living? Very similar to the early model that Ben had put together. And by the way, they had done that already, 2015, 16, that's really how they got started. And so, true to kind of Revive's investment thesis, we really kind of look at what stock is on the ground, and we try to keep that, innovative approach to affordable housing in mind. And for us, when you think about gentrification, a lot of it is pushed off on these college educated, high paying tech job people who are moving into these cities. And again, they're seeking the affordable housing. It's no secret. And I think we're seeing even like a residual tension there, right, amongst these people. And the larger ideas, we really kind of methodically went through the pro formas and everything was, this is something that we can increase the density by like 200 to 300%. And we can really cater to this audience of people who are also need affordable housing. I mean, the majority of people in that demographic are paying well over 30% of their income to rent, right? That's considered a rent burden. And so on top of that, this ability to increase density in an otherwise non-dense product, this idea of missing middle housing very quickly is the fact that we're not building housing in the 4 to say 50 or 30 unit size and scale anymore. Like a lot of the quadruplex and 10, 12, 15 unit apartment buildings that were built 20, 30 years ago, they're just economically feasible to do so. It's very difficult to build in the Bay Area. And, what's happened is these large institutional developers are the only ones who can afford the risk and the ability to do it. The problem with that is it takes 5 to 6 years to build a project, right? And so what happens in 5 to 6 years? Gosh, in 5 to 6 years, these neighborhoods are changing rapidly. We need affordable housing now, right? And so in addition to kind of this 2 to 4 unit that we could convert to 10 to 16 bedrooms, there's a lot of old industrial warehouses in the Oakland market. And so Tyler Kovic of Design Draw Build and I kind of put this other model together. Hey, can we convert some of these warehouses into live work lofts and kind of bring in a co-living, co-working type environment, which is, jives very well. Again, taking a otherwise industrial use and turning it into residential, which, mind you, this wasn't a earth-shattering idea. People have been doing this for years, right? But it was just, again, intuitively looking at, if we can do this like without having to go to planning approval, kind of do it by right, and really focus on this 12 to 50 bedroom space. We can deliver units a lot faster than a traditional developer, and help solve this problem because we're delivering rents that are going to be at the lowest threshold of the market. A co-living bedroom, if the studio rents $2,200, we're offering beds $1,800. If you're building a mid-rise, you're offering rents at the very top, right? So it's really this idea of like, we could deliver quote unquote affordable units per AMI, or area median income for those people who are unfamiliar. That's how they measure housing affordability. There's a lot of things that get based around that. But we could deliver at that lowest threshold and be able to do it at scale. And so that was the idea, right? That we kind of created this, with real life examples, but also in a vacuum, because when you pro forma things and you're doing things in real estate, right? There's the pro forma and there's the financials, and then there's reality, right? And so we spent the next 16 months really aggressively going after the strategy. And then that was kind of it. And I'm sure the next question is going to be, why didn't it work? or why haven't you done it at scale, which I'm happy to answer, but I'll stop for there in case you want to pivot.
Yeah, well, no, you took the words right out of my mouth. That was going to be my next question. But I also think it's interesting. And if you could highlight this, I mean, the Bay Area is notoriously expensive, right? Even rather be, San Francisco, and then even in Oakland, it's, I mean, one of them, like one of the most expensive parts to live in the world. I mean, absolutely. I was there maybe a year and a half ago, and I was staying in like a hostel. Okay. And it was like $1,200 a month for like a hostel with like 8 other beds in there. Right. So first of all, what a great business if you own that hostel. But there's a massive limit to sort of what they allow to be built. And that's part of what's sort of driving the cost, is because the supply is not increasing, but the demand is increasing as people, as we just see, that's like a hub for tech and a lot of innovation. So, you sort of look at that and that sort of explains why housing is so expensive in the Bay Area. And I'm sure it applies to a lot of other areas, but this is sort of a great example as to why housing prices continue to grow in areas like that. So now go on with telling us what went wrong and why it did not work.
Yeah, that's always the fun part in real estate, because there's too many success. Like there's a million, you'll go on Facebook tomorrow and find a million success stories, how easy it was and how simple it was. And I think the thing that I love about real estate is the nuance. Like, I mean, it's a love-hate relationship. But there is a lot of nuance in real estate. And so the thing, going back very quickly to your comment, the statistic that I constantly throw out is, I can't remember the exact period. Maybe it's like from 2010 to 15 or 15 to 18. The Bay Area produced 7 jobs for every 1 housing unit. Okay. A supply constrained market is considered 3 to 1. So we're double what a supply constrained market. Oakland was the East Bay producer. This is a more recent statistic that I've come through. We were the largest, Oakland was one of the largest producers of multifamily units over the last year or two, 5,000 units. Dallas, Denver, those guys are Salt Lake, Some of those markets are pumping out 10,000 units a year. Like we need 20,000 units a year per, the standard to get to that. So we're barely even, we're barely even hitting that. So yeah, that's and there's a lot of arguments. I probably get just burned at the stakes for a lot of people in the affordable housing and the opposite side of the policy who don't believe in. I just want to put this to bed. It is 100% economics. There's, in addition to all, the planning and rigmarole you have to go through from a development perspective. But yeah, and that's, to answer your question, that's really one of the first problems. Like the biggest problem that we have in this is that it's just not that easy to do this. We kind of did this in a vacuum and thought, hey, we've really found a way to kind of crack the code. But as far as the things that really, challenged us, there's a few key things. And let's start with the smaller product, the 2 to 4 unit kind of product. For one, there's a consumer buyer, someone who's going to live in that, who can go maybe get an FHA loan, right? Who's going to pay a more aggressive pricing. We kind of thought initially like, hey, we're getting a higher rent per square foot, a much higher NOI, like we're going to cash flow these things, like we should be able to pay more. Okay, that was the thought process. Like there's no reason why we shouldn't be able to compete with these people that I'm getting ready to name. First one is kind of an owner-occupier, first-time home buyer saying, hey, I can buy single family, or I can buy a do-tri-quad, have someone pay my rent and pay maybe half of what I normally would. Again, affordability is very important to a lot of people. A lot of people are doing that. People in the smaller scale real estate investment is called house hacking, right? Yeah. It's a great strategy. So that was the first person that we were kind of competing with that ultimately was driving the prices up further and further for us. The second one was, what we found is a lot of these fix and flippers, they'll run small construction crews. And what they do is they just kind of hop from project to project. And because we were wondering, we're like, how are we not beating these guys? We started kind of re-engineering the numbers and looking back through it. And what you found was they were kind of just rolling their profit margin into the deals. They're 12 to 18%. We're hiring, a like nice, like I say, nice. We're paying a rather expensive general contracting firm. Sorry, Tyler, but W-2 employees, workman's comp, like they do everything by the book, right? Like pull permits, the whole nine. So our cost structure is a little bit higher. So that started limiting us because these fix and flippers, we're like, man, like how are they making this deal work? Well, they're doing 2 or 3 projects a year and doing very well, just kind of rolling their profit margin into it. So the competition there, that was kind of the first key thing. The second thing is we started looking at deal volume. How many deals were we taking swings at and either taking strikes or, potentially getting into contract with. And what we found was deal volume was incredibly low because with rent control, you don't get a lot of vacant units. You get a lot of units that have tenants. And we're not in the business of trying to, either evict tenants, which is extremely difficult, would definitely not fit our business model, or go through the process of buyouts and negotiations around buyouts, which mind you, they happen. And it's, it's expensive, it's time consuming. We want to get product on the ground, right? The interesting thing with the industrial warehouse piece, adaptive reuse, again, deal volume. We were seeing like under $30 million in deals that could potentially make sense for us roll into our pipeline every, year or 6 months. In addition to that, we were buffering up against a lot of competition from cannabis growers. Not a lot of people have an interest in an under 20,000 square foot blank warehouse that's, brick facade and timber frame, right? You would normally think, hey, I can buy something like that on the cheap. Well, when you put a bunch of cannabis plants in the middle of it, it suddenly becomes a very expensive piece of real estate, or, an extraction. I mean, these guys are using these things in all different ways now because the cannabis market is literally blowing up, and California law caps you can't have a cannabis facility more than 20,000 square feet for a permit. So there you go. It's got like those kind of 2 magical storms and really kind of writing out the end of the cycle. We were at the end of the cycle in 19. We're arguably still kind of running into that. We've seen some price softening through that time frame, but really we were making offers that we thought were fairly aggressive, and people were just kind of nodding their heads to us, and it was just kind of one of those things for us that we're like, man, this really isn't working. We really want to crack the code on this. So, that we kind of left. And again, right now we're in the process of working with a developer down in LA We're still continuing our strategy in Northern California and hoping that pricing comes down.
Mm.
But we really started evaluating this during COVID, because what happened also is rents dropped in 2020, but pricing stayed the same. And so you've got this, 15% delta in rent drop in Oakland and San Francisco, but none of the pricing has really come down on product. And we're a rent-driven product, right? So we're kind of in a holding pattern here in our NorCal strategy. I mean, we're still aggressively going after it, but it was a lot of those factors. The other thing that I forgot to mention is just the debt became very expensive for co-living around that time. It's still expensive. It was before the pandemic, but especially now because of the perceived risk around that. So, a lot of those fix and flippers and guys and gals who we're kind of competing against, they've got access to a little cheaper capital. They can go get residential financing and stuff for their projects, and sometimes for those who are in the industry, that's 150, 200 basis point spread, fancy term. We're looking at interest rates, a percentage and a half to a percentage higher than say a small fix and flipper who's just doing, resi loans. So it's a pretty expensive cost to capital.
Yeah. Wow, that's such fantastic insight, and I hope
I appreciate it.
anyone who's interested in real estate investment um, and development listens to what you're saying, because, like you said, there's a lot of success stories, and those are always going to be pumped out. But it's
Yeah.
sort of, when you go through sort of the first roadblock, and it's like, okay, sort of what's the next game plan? But often that's sort of the thing that sort of fine tunes your eye to see what the next opportunity is, or if this, it just changes based on the market or whatever it is. One thing that sort of came to mind was, so for example, like at the heart of co-living is community, right?
Mm-hmm.
And living with other people and amenities and all that sort of stuff. And so, I mean, you think about a 5 to 20 person, basically co-living complex, and that's really sort of the sweet spot as far as getting to know, your neighbors, your roommates. Like that's a good point. But based on sort of some of the things that you're running into, it really makes it hard unless you're, Star City and you have this major bankroll to build things that are, 50 plus, 100 plus. I mean, I don't know how different the rules are in, I think it's San Mateo, where they have, 1,000 bed complex, but it really doesn't really allow for someone in a company like yours to get in and make things that's, I'd say, like really core to the co-living experience, which is like 5 to 20 person.
Yeah. Yeah. And I wanted to say, like, for us, that strategy was quote unquote dead. We use that as a catchy, phrase and writing material. It may not be dead. I mean, there's probably other cities that maybe it works. We just haven't identified them yet. But I do think that when you're talking about delivering products, multifamily product, whether it's co-living or, workforce housing, whatever nomenclature you want to use, just call it, a 1 to 5 bedroom apartment, in that kind of 10 to 50 unit range. It's insanely difficult. I don't care where you are, right? That's this idea of missing middle housing that people are starting to catch on to in the industry and hopefully within the public sector. I think it is possible. I mean, certainly there's a market out there that it has to be possible, right? And to your point, there's going to be different iterations of what co-living is, right? We're obviously gravitating towards purpose-built co-living because it is extremely difficult to find product that you can convert to make it adaptive and make it work for co-living. But I agree with you. It's like the way that I think about it, the developments that you're referencing, it's a feeling of authenticity, right? And the community is delivering that authenticity.
Mm-hmm.
And, when you live in a small house with 10, 20, 15 people, there's an intimacy around that. Now, that house would be split across, 4 units in one of our developments. Maybe only 2 of those pods, of those 5 bedroom pods, would be sharing a common area space. But yeah, I mean, there is, and if you think about the type of product that's usually in the low to medium density area, that's a neighborhood, right? It's not like a city core, it's a neighborhood. And I think there's a lot of draw to those neighborhoods. That's a lot of people end up doing kind of the Craigslist model and stuff around here, is because, they have a neighborhood vibe, they have parks, right? Not everyone wants to be in that CBD, that central business district, living in a high rise. It works for some people, not for all. And I do think that, part of my interest in engaging this topic, to your point, is like really trying to open up more of the dialogue of, well, who are some people that are kind of doing it in that range, and the difficulties that are around it. Because, again, like, I'm a big fan of it. I think there is going to be more authenticity. I think people are going to be more drawn to some of those co-living developments. Not to say that people doing in the mid-rise and high-rise can't, have a sense of community and have a sense of engagement and if they do it right and they design it correctly, I think absolutely. But it is an interesting opportunity that, again, we were excited to talk with you about it. And I think it has to be an incredible, like, large part of the conversation when you talk about co-living, right? Because I think that's what people are drawn to in the first place.
Yeah, absolutely. And Connor Moore we talked about this maybe a couple months ago. He brought up, and I mean, these are all things I think we intrinsically know, but when you think about it, applied to co-living, once you get to a certain number, it's hard for co-living to scale, right? We
Yeah.
can only have so many friendships, so many acquaintanceships, like and when you have a building that's so large, yeah, there may be, your floor, a couple people like that, but it does just make it a little bit harder. And like you said, I think, and I hope one of the things for co-living is it's able to branch out in a lot of different directions. And that's not only these places in, where you have 500 beds in a high rise, but you have 5 to 15 in a duplex, or you have it geared towards actors or people in health. And I think that diversity will make it really, really cool as to what is possible with co-living.
Yeah.
And I think this is a good segue. I'm killing the transitions today, I'm not gonna lie.
You are. It's great. It's making it very easy and fluid for me. Thank you.
I know you anytime, man. For a webinar that you did recently, called "The 4 Reasons Why COVID Will Be the Hottest Sector in Real Estate." And I think we've sort of been talking about this for a while in co-living, like, hey, people are so lonely right now. And you're looking at it from a little bit of a different angle. Obviously, that's part of it too, but
Right.
obviously you're thinking about it also in terms of real estate and investment opportunity and all that sort of stuff. Let's talk about a few of those reasons now. Talk about those 4 reasons that you think it'll be one of, if not the hottest sector in real estate.
Yeah. I mean, you automatically maybe want to dive into one, but I'll go in order. The big one for me was, when you look at the population that migrated from the cities, right? It's kind of heavily 2 demographics. There's the Gen Ys, or excuse me, the millennials, which is Gen Y, who were grown up, right? They're moving into the first-time home buyer market, and they left. They were like, okay, it's time to go. Like, it's time to move out of the itty bitty apartment. Let's move to the burbs, or let's go buy a house somewhere where we can afford, right? It's been happening for decades. And for me, the other perspective of that is kind of this 18 to 29 demographic that moved, the Gen Zs and late stage millennials that probably moved back in with mom and dad, said, if I can't enjoy this city, why I'm going to live here? And you essentially saw that, the San Francisco's and New York's of the world, rents plummeted, vacancy increased through the roof. And, the kind of that first philosophy for us was like, who's the most healthy demographic that's going to enter into the cities first? It's 18 to 29. They're the least at risk for hospitalization with COVID. Hopefully, they're going to be, vaccinating themselves plentifully, and reducing risk that way. And just kind of this larger idea that if what we went through outside of being a pandemic from a economic perspective was a recession, these large cities, San Francisco, New York, they're the first in, first out. So it's kind of a first in, first out on demographic, first in, first out on city. I mean, they're the usually ones that take the lumps early on, and they're usually the ones to first recover. And so the idea behind the demographic, as well as this shift within our cities, I think the cities are going to start to heat back up again, just like they were before. That's kind of the first one. I mean, the second one was, this idea of co-living 2.0, which, when you and I first talked, like that was the thing that totally set the conversation off, right? It was just that, and the one thing we did in the webinar was we kind of compared the beds in the Cushman and Wakefield 2019 report, which is like hovering around 4,000 or something. And we compared that to privately built student housing in the United States, which if you can compare those two numbers, there's some differentiation there, right? Like private built student housing doesn't mean that there's that many, demand, right? But just kind of size and scale, 3,000 to close to 4,000 co-living beds being built across all operators in 2019. There's 2.7 million privately built student housing beds in the United States, right? Wow. Other things that happened, there were some operators, some co-living operators, right? They went belly up. They didn't have solid business models. That happens in every economic cycle, right? There's some people who just didn't have solid business. They weren't on solid ground. Maybe they chose scale over profitability. That's the VC thing. They didn't work, and that's fine. And what, interestingly enough, within that, you got Common, who's really at the top of the food chain right now. And the interesting thing to me is when you see like major players consolidate in an open field like that, I always feel like it's indicative of the promise of a market. And we saw that happen. Star City, number 2, roughly 3 or whatever, and Ollie, number 4, in as far as production of co-living beds, they joined forces during the pandemic to go after Common, I'm assuming. And so to me, that's just like, now you got 2 major horses in a race, right? I think Common just closed like a Series D or E or something, 66 million. I mean, they're kind of off the charts. So I think that, as far as the adoption cycle, where we're at in the chasm, I mean, co-living's at the inception, right? And this is kind of the new, call it the new dynamic of what's going to be co-living. And like you said, that's even beyond that. We're just talking about strict co-living, not even the different market segments, senior housing. I mean, there's all these different, kind of lifestyle living. I mean, we could sit here for another 45 minutes, right, and talk about all those market segments. The third one was affordability. I mean, we've talked about it and kind of danced around it. I mean, this demographic is not, they are not immune to the same problems that the millennial generation had, right? Which is, graduating with an excessive amount of student debt. They're forming families later because housing is not cheap. If you want to buy a house, it's, you've seen that pricing go through the roof. Here in the East Bay, housing prices have gone up 13% through the pandemic. This is like we're supposed to be in a recession and a global pandemic, and people are buying houses, driving up prices. But there's no stock, and people are going to be in the renter market later. And we've got 45, if not 50 million Gen Zs about to hit the market over the next 10 years. They're going to replace the millennials in size. And I don't think that, a lot of people have said, oh, everyone's moving to the burbs. Like, that was kind of one of our first points. We're like, no, they're not. The millennials are moving to the burbs like their parents did and their parents did, to buy a house because that's where it's affordable. Gen Zs, I don't think are going to be suburban dwellers, maybe like just outside CBD, but every indication points to the fact that they're going to want to be where the action is. They're going to be where the cities are. And the fourth piece was just so much about how I think a lot of people in the industry and people who aren't familiar with co-living, they see this as like this new thing, right? But for the last 20 years, if not longer, people have been moving to major cities, butting up with people in large format apartments, call it 3 to 4 to 5, 6 bedroom apartments, to bring their rent down, like with people they don't know, right? When I moved here, I got a 2-bedroom to bring my rent down and put an ad on Craigslist for roommate search, right? Go to the Craigslist roommate search in these major metros. There's thousands of inventory that's available, right? And all that co-living is doing is just kind of monetizing that model and removing a lot of the headaches associated with it. Who's going to clean the place? Who's going to furnish it, right? Is it a nice place to live that's recently been upgraded, or is it kind of dumpy that the mom and pop landlord, put some lipstick on and the stove's broke and the microwave works, sometimes before it blows out the fuse, that we have to go to. It's just, we've all been through these types of housing, right? And what these co-living developers are doing, they're delivering a far superior product. And they're doing so on these things. Well, you can't see that, but that's my phone.
There we go. There it is.
There you go. And that's the interesting thing about Gen Zs, and you see this all the time in the real estate space. People are talking about how tech integrated they are. And, where a lot of these co-living operators have, built their business models around is they've made it easy and accessible for people to view their apartment, to book, lease an apartment, to express interest. They all opened up, 3D floor plans and video tours and, invite you to their community events that they host. And they're just adding on the amenities. And Gen Z, when we look at them as a demographic, you dig more into them. I'm going to sound like a grandpa when I say this, but they're going to have it easier than anyone with regard to amenities, right? Because they're the generation of everything is accessible via their phone, right? I mean, I ordered my new MacBook Pro and I had it delivered to me that same afternoon for $9 from Apple.
What?
It's $9. And mind you, the price is not $9.
Yeah. What service was that, by the way?
Apple brought it to me.
Wow. Interesting.
And so if you think about that, you've got Amazon, you've got Instacart, you've got DoorDash, all these companies, right? If I'm a millennial, a millennial, if I'm a Gen Z, everything's accessible like this. And if you think that they're going to want to enter into the Craigslist, apartments.com, I mean, I've been through that process. It's not fun. Yeah. Right? I mean, you're showing up to maybe multiple interviews or, meetings with people. I mean, this is something that you're going in, you're renting from a highly vetted property management company, again, backed by millions of dollars of capital. This isn't like some local mom and pop shop, which some of those do a fantastic job. I don't want to discount them. But this is a smooth operation. And that's the other interesting thing about co-living is like, I'm going to steal a metaphor from a buddy of mine, Brett Swartz, who does the deferred sales trust. We did a webinar together. It's Blockbuster versus Netflix. That's the only way that I can see it. It's as far as like the way that people are trying to secure co-living housing now, via the Craigslist and kind of buddy up model versus co-living. And that's the one that gets me the most excited, because when you talk about things in the context of the tech world and business development, it's like, what's the old business model? What's the old way of doing things? And how is that catering to not only just the masses, but a specific demographic who has a very distinct problem, right? Which is affordability, which is that they're going to have to go and work off this college debt. They're going to want to live in cultural centers that are cities, and that was kind of the wrap of it. And thank you for giving me the opportunity to roll through that and get a mini plug on the webinar. But obviously, all the reasons why we're super excited about the product and kind of what we have coming through the pipeline. So,
yeah, I think that's a really, really wonderful description of why co-living is probably going to take off. I mean, it already is in some cases, like you said. Yeah. We're seeing, mergers between Ollie and Star City and all these companies sort of come together, and there really is a ton of capital being deployed to make sure this happens. Sort of funny is how I got introduced to co-living is I was so I built an app for finding roommates. It was like a Tinder for finding roommates kind of deal, right? And a ton of mobile apps were getting funded, not in this space in general, but Tinder, or you had a lot of things like that I don't want to say are gimmicky, but are just like make life easier, right? Yeah. They're not Craigslist. It's almost unbundling one aspect of Craigslist. And so we were working on this thing and we had a good amount of traction on it. And I was wondering, I was like, why is nobody in this space getting funded? And us as well. And I remember there's an article on Crunchbase that was maybe 2018 about shared housing startups take off. And I was like, wow, this is awesome. Like, I wonder if they're going to talk about the one company that's raised a good amount of money that's, connecting roommates. And like you said, there's massive friction around that. And as I went through the list, I was like, Star City Common, I've never heard, these are not mobile apps or web things. So I looked them up and I was like, oh, that's interesting. But it's funny because the innovation was not in the actual technology part, because that's only solving part of the friction, right? Mm-hmm. But really the revolutionary product is actually in the real estate product as far as the housing goes and the amenities go. And so I think sort of how you're connecting Gen Z to co-living makes a ton of sense to me. And I haven't really heard it in that way, where it really does address not only the pain points of like most people, where like, you could find a weird roommate, or what if they, don't pay rent on time, or ABC, but it's sort of like, oh, they want to live in a cultural city, right? They want to be not dependent on their roommates. They want to have an individual lease. And that's probably where the magic of co-living is just reducing all the creepy, weird things that maybe our generation had to worry about. Where as co-living gets bigger, you're just not going to have to worry about it as much.
Yeah, it's going to be a much more turnkey process.
Yeah.
And that's the interesting thing. There's in all that alleviation of friction, right? It's creating a new friction. Whereas these operators, these property management companies, they need product. And there's not a lot of developers who are able to kind of crack this code, because real estate development, right? Investment is not that easily scalable, right?
Yeah.
It takes a lot. It's a big engine. It's a big ship to turn around the harbor, and it's just not that simple. It's not a software solution. You kind of have to go. There's a lot of nuance to it, which I won't get into, but and that's kind of the new friction. But I mean, it's an interesting problem, right? Because I mean, on our side of things, that's our job, right? That's we have to find a way if we're going to be successful. But yeah, it's going to create a temporary friction, I think, in the space, just because and I think there isn't one company in that list that's already starting to branch out into other forms of traditional property management. So I think you're already seeing that happen. It's like we've got to fill, the growth plan, and we're kind of cramped. It's going to take some, but I think there's just going to be a consistent. What's going to happen on the flip side of that is going to be consistent demand, right? You're going to have, and we've seen this with Open Door, local operator, where they have a significant wait list, and so if you're trying to secure funds from a real estate for syndication or fund, you're saying, hey, we've got 1,000 potentials here, to fill this 50-bedroom apartment complex. That any investor, I think, is going to bring a degree of comfort there, and probably just another reason why I think things could scale up very quickly. But again, there's going to be a lot of friction in trying to find good product. And we've seen some bad product too, some conversions that were like, that's kind of a low bar SRO model. That's not going to be your co-living, right? There's already these kind of players out there who are just, hey, let's see how many people we can stack in. You're going to have that. But
yeah. Don't name names, but maybe shoot me some names afterwards so I know who you're.
Well,
right?
we're
not
funny because those are more like, honestly, it's the smaller scale developers, kind of the mom and pop guys, the small guys and gals. I mean, that's where we see it, and it's so blatantly obvious, that, but yeah, I wouldn't say it's anybody big. I think a lot of those companies, especially in institutional space, there's a very high standard there as far as the product you deliver. And, there's in the real estate investment arena, there's always a few, call it bad apples, who aren't as product focused, who are looking more at a dollar than the product they're putting out. So
right. So we're coming close here on time. Before we started this, you were mentioning sort of what you're in the process of, what's next. You mentioned already working on something in LA. Tell us about where Revive's at, what you're doing, and what's next for you.
Yeah. So we've secured a joint venture with a company who's actually doing, basically mid-market development at scale. They're doing it in the LA market. So we've secured an opportunity to go raise some capital on their behalf for some of their projects that they have coming out of the ground, which we're really excited about. LA is one of those markets that, there's been this developer, and in addition to another developer, they've cracked the code. They found a way kind of within that planning code that they can get product through the approval process, following the planning code, but using co-living as a means to kind of expedite things a little bit. And, because it's delivering an affordable product. And so we're really, really excited about that. Again, we're continuing our NorCal strategy on that 12 to 50 beds. We're not giving up on that. We're still looking at product every day, making offers every day. We just became decreasingly bullish on the ability to really, with the equity that we have in the pipeline, to place that equity. and from a syndication and from a fund management perspective, that's our job. We have to go find projects for our investors to invest in. So it was really important for us to do that. And I'd say that's been the kind of the key thing. And then looking into some market expansion. There's a couple key markets that we've got our eyes on, that we've had our eyes on for a while, that we really want to expand out to, because we also started as just a traditional workforce housing investment company, focused on B and C assets. We've started in Sacramento and got a deal secured, and then they passed rent control, and it's just been hurdle after hurdle. Matter of fact, we didn't see a multifamily value add deal over 30 units hit the market in Sacramento in the last 60 days. So it's just, there's just no inventory, and we saw inventory drop almost 50% year over year through the pandemic. So there's a lot of headwinds in the marketplace right now. So I'd say we're anxious to not only, work on these LA deals that we have coming through our pipeline, but continue to expand in other markets that maybe there's some better return profile. There's not as much cap rate compression for us. And, we can take a lot of these, ideas that we have and kind of these innovative approaches to affordable housing. Co-living is one of them. Got some interesting ideas on the workforce housing product side of things. And, just growing our portfolio that way and really talking about how we're going to secure, this next stock of affordable housing for people, and kind of bypassing, or not bypassing, but creating another means of doing it outside of just the traditional bureaucratic, take money and redistribute it through subsidized housing model. I mean, I think if we're going to make it through this problem that is affordable housing for people, and that isn't, these mega commutes and, 2 to 3 hours outside of central business districts, we're going to have to get innovative. And let's say for us, that's kind of staying on that kind of North Star, looking at those ways and opening up those markets and continuing, looking for other ways to do that is exciting to us and kind of a big part of what we're doing. So.
Well, that's super exciting. Where is a good place for people to either contact you, contact the company, follow the research and blogging you guys are doing on co-living?
Yeah. I mean, just go to our website. So it's www.re-viv.com. There's a contact form on there. We've got those little handy dandy scheduler tools. You can book a call with me personally on there. You can inquire about, getting our offerings. I think we've got all that stuff set up now where it's automated. It'll send you out some potential deal flow. I mean, we're still kind of old school in that. We're optimizing a lot of that stuff to make it, but if you just go on there, you'll literally get the opportunity to book a call, or you can reach out to my team. You'll hear from someone within 24 hours, and we'll schedule a call and just kind of walk you through. I mean, we get people from all walks of life, so we try to keep it pretty open-ended, and just understand what people are trying to accomplish, in the real estate space or in the particular products that we're focused on. So yeah, just hit us up there.
Cool. Well, Matt, thank you so much. I think this is probably one of my favorite podcasts I've done.
Oh man, thank you so much. That means a lot.
You're bringing it totally from a different angle. We've interviewed, people who have lived in co-living managers, co-housing, which is a little bit different, but to hear it from the sort of back end, I think is really, really interesting. So Matt, thanks so much, man. Appreciate it.
I greatly appreciate the opportunity, Paul. Thank you.